If your IT sector investments have been looking absolutely battered lately, you're not wrong, and you're definitely not alone. Something real is happening here, and it's bigger than just a bad quarter. Let's start with the money that's already walked out the door. Foreign institutional investors. Think giant global pension funds and hedge funds. Sold off 10,956 crore rupees worth of Indian IT stocks in just the first 2 weeks of February 2026. 2 weeks. That's not a correction. That's a fire sale. And zoom out a little, and it gets even more uncomfortable. FPI ownership in NSE-listed companies dropped to just 16.9% by March 2026, the lowest it's been in 15 years. Now on screen you can see this data comparison laid out clearly, and that trend line is not subtle. Imagine the most well-informed property investors in your city suddenly offloading everything at once. That's the signal this sends. So why are they running? Two things hit at exactly the same time. The US slapped a $1 lakh fee per application on H-1B visas. These are the work permits Indian IT giants like TCS and Infosys use to deploy their engineers at client sites in America. At that price, you're not talking about a paperwork cost anymore. You're talking about a direct punch to profit margins, multiplied across thousands of employees. And then there's the growth story, or rather the lack of one. TCS and Infosys posted sequential constant currency growth of just 0.3% to 2.3% in Q3 of financial year 2026. Compare that to the double-digit growth these same companies were celebrating just a few years back, and you start to feel why global investors are quietly heading for the exit. So that's the storm. Foreign capital leaving, US policy making operations more expensive, and top-line growth that's basically flatlined. That's the pressure cooker Indian IT is sitting inside right now. So we know the pressure is real. But here's the question nobody's asking loudly enough. Who actually gets hurt here, and who's quietly lining up to win? Let's start with the pain side because it's real and it's significant. Sustained FII selling. Those big global funds walking out the door. Keeps a heavy lid on IT stock prices in the near term. If you're holding IT stocks right now, your portfolio is taking a hit on paper. No sugarcoating that. And for the companies themselves, the $1 lakh H-1B visa fee per application is a brutal cost multiplier. Think about it. A mid-sized IT firm sending 200 engineers to the US every year is now looking at potentially $20 million in additional visa costs alone. That money has to come from somewhere. Profits, billing rates, somewhere. Now here's where it flips. When big players sell in a panic, patient buyers smell opportunity. And that's exactly what's happening right now. Domestic institutional investors, DIIs, your Indian mutual funds, insurance companies, pension funds, are accumulating IT shares as FIIs head for the exit. It's the classic distressed seller, calm buyer dynamic. Someone's offloading at a discount and someone else is very quietly saying, I'll take that. The data backs this up. Look at the Nifty IT P/E ratio right now. It has actually dipped below the Nifty 50's P/E. For those unfamiliar, P/E tells you how much you're paying for every rupee of a company's earnings. When IT's P/E falls below the broader markets, that's the sector trading at a multi-year valuation low, cheaper than the market average. That's not a common sight, and for contrarian investors, that's a signal worth paying serious attention to. And then there's a third quiet winner, pure play AI and automation providers. As traditional IT firms absorb the shock, enterprise clients are redirecting their budgets toward AI tools and platforms. The companies building those tools, they're watching the money flow their way. So yes, this market is in transition, and where you sit in it changes everything about what happens next. But knowing there's an opportunity and knowing what to actually do with that information, those are two very different things. In the next segment, we get into exactly that. So now the real question. Is this just a rough patch or is something deeper breaking underneath Indian IT? Honestly, it's both. And knowing which changes everything about how you respond. The FII sell-off, the H-1B cost shock. That's cyclical. It hurts, but it passes. Most analysts are pointing to FY 2027 as the stabilization window, and here's why that matters. AI deployment is expected to stabilize IT revenue growth by FY 2027 as the sector shifts from companies just dabbling in AI pilots to actually rolling it out at scale. And when that happens, the IT firms that position themselves as the ones who install, customize, and manage these AI systems for clients, they can unlock entirely new revenue lines. That's the recovery thesis, and it's real. But here's where it gets uncomfortable. Think about what electric vehicles did to legacy automakers. These companies spent decades mastering combustion engines, pistons, gearboxes, exhaust systems, and EVs made almost all of that expertise irrelevant almost overnight. AI is running the same play on traditional IT services. Manual coding, software testing, repetitive back-office work. That's the bread and butter of Indian IT, and it's exactly what AI automates best. That structural AI disruption parallels what EVs did to legacy automakers, and firms like TCS and Infosys know it, which is why they're racing to reskill workforces and acquire AI capabilities before the window closes. So what should you actually be watching? Track DII buying. when domestic funds are consistently accumulating that smart money signaling value. Watch for real AI client wins in FY2. 027, not press releases about pilots, but actual deployments. And keep one eye on US immigration policy. Any softening on H-1B fees would immediately take pressure off margins and could trigger a sharp recovery in IT stocks. The sell-off is real. The structural challenge is real. But so is the opportunity. For those who can tell the difference between a sector catching its breath and one genuinely figuring out its next chapter. The question was never whether IT recovers. It's whether today's giants lead that recovery or watch someone else do it. Follow us for more updates like this. Thanks for watching. And don't forget to follow us on YouTube, Instagram, and X.